exactly how the upcoming housing crash is going to occur step by step. Because this is such a complex topic, I'm going to break it down into 7 really easy to follow and easy to understand steps. Between the year 2000 and 2005, home prices across the USA grew by a staggering 50% in just 5 years. By 2005, 40% of all house purchases were as investments or second homes. 40%. And this, ladies and gentlemen, begins stage 1, where a house no longer becomes a home. Speculation from investors and, more importantly, REITs push house prices up in that area, forcing families out of the affordability range for many houses. And this is where stage 2 began. The brokers got rich by selling these mortgage products to just about anyone. The banks then got rich by packaging up all of these mortgages and selling them as CDOs, which stands for collateralized debt obligations, which is basically packaging up all of these mortgages in a big bundle, some of them exceptional, some of them, well, crap, and then selling them to pretty much any financial institution or investment fund that would buy them. With a AAA rating, of course, CDOs were then rightfully outlawed. But you know, these crafty bankers, they came up with another way to recreate the CDO. They called it BTO, a bespoke tranche opportunity. Very clever. If this wasn't crazy enough, banks then started to do swaps with other banks with these crappy bundles. Stage 3 was, of course, people living beyond their means and creating a bubble GDP. GDP is gross domestic product, which I won't go into now, otherwise it will overcomplicate the video, but this is basically all the goods and services that a country produces in a set amount of time. Stage 4 is where we go into crisis mode. In the 2008 crisis, this was caused by the shadow banking sector and holes on Wall Street. In this 2020 recession, this has been caused by a global virus. How a crisis comes about is irrelevant. The important thing is really how the central bank of each country deals with the crisis to overcome it. Stage 5 then takes us into the realm of high unemployment, signaling the start of the recessionary cycle. What is the recessionary cycle, you may ask? Well, it means high unemployment, meaning job losses and wage cuts, where we are right now. And because people have less money, there's then a lesser demand for products and services in the marketplace. Stage 6 is always the central bank to the rescue. During the 2008 crisis, the Fed's weapons of choice were as follows. Number 1, interest rate cuts. This is the most powerful weapon that any central bank has. It is like bringing out the big guns, and during the 2008 crisis, the Fed were able to slash rates right down close to 0. What this does, it stimulates the economy. It allows business owners and people in general to borrow money very cheaply, and therefore stimulating the economy. Number 2 was targeted assistance to failing or struggling financial institutions. Bailouts. Bailouts. Number 3 is quantitative easing, a term the Fed hates us to use. Right now, central banks only have 2 out of these 3 options available to deal with this financial crisis. And unfortunately, their most powerful weapon is out of ammunition, and that is interest rate cuts in order to stimulate the economy. And this is because the country still hasn't quite 100% recovered from the last financial crisis. So all the central bank could do was cut the base rate right down to 0. Bringing us into the final stage, stage 7, which is where the crash should happen, should be happening right now as we speak. However, the reason it hasn't is because central banks have created a new bonus round. The bonus round is called mortgage forbearance, also known as a mortgage break in other countries. So we'll call this stage 7 part A. And pretty much everyone has bought into this myth that this is going to stop the housing market from crashing by simply allowing homeowners not to pay their mortgage for the foreseeable future. And this brings me on to my final stage, which is the final stage of this cycle, stage 7, part B. And since this is the most important stage now that I'm about to explain, stage B then, our final stage, is where this mortgage forbearance, which is currently at 9% by the way, 9% of all mortgages are in mortgage forbearance. Still, today, as we're about to go into July, 9%. When this finally runs out, this is when we end this cycle. Because with such high unemployment, people, families are simply not going to be able to afford the monthly payment they were before on their house, their home, and they will really only have one or two options. Number one is give it back to the bank, or number two is sell it on the open market and to cash out whatever little bit of equity is still left in that house, in that property. Part 1 of the mortgage forbearance program was April, May and June of 2020, which we're coming to the end of right now. I didn't think there'd be a problem at this stage. Part 2 then is this next 90 days, comprising of July, August and September of 2020.